Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix, Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Eli Lilly, stock's hitting an up 4% today, all-time high. Stock's up like 58% year to date. Patients taking Eli Lilly's blockbuster weight loss shot were 94% less likely to develop diabetes in a 3-year study that illuminates the long-term health benefits of treating obesity. And Alix, as you mentioned, these are just like wonder drugs. I mean,
it definitely feels like they're all magical.
They're magical. They cure everything. So I need to figure out what's going on here. Sam Fazeli, he joins us. He's the director of research for global industries. He's a senior pharmaceutical analyst. That's his day job for Bloomberg Intelligence. And believe it or not, he's actually at his desk in the London
He was in
studio.
Bordeaux on Friday. On the phone.
I was going to say, I expected him to be in some, dialing from some exotic locale in Europe somewhere, but he's actually working.
This is exotic. Look.
Yeah, exactly.
Well, the ceiling looks pretty cool.
All right. So,
yeah.
Sam, I mean, well, thank you for coming into work as opposed to your peers there at BI. Sam, talk to us about Eli Lilly, their drugs here, and obesity. These numbers just jump out at you, don't they?
They do. But let me take you back a little bit. Were we not always told when we went to the doctor and we started, our glucose was going up? Not you guys, obviously. You're fascinatingly, amazingly healthy and fit. But those who weren't, and told you need to lose some weight, my friend, because you're at risk of developing diabetes. So where is the shock? If you reduce weight and manage the obesity, you lose all these, I've been repeating this thing, sleep apnea, risk of developing diabetes, everything that we're talking about here. You eat less, you lose weight, less risk of developing diabetes. So not exactly a shock. Nevertheless, it's great to see that it actually does what it says on the tin, that by reducing weight, you do manage all these side effects. But before we get too excited, I want to highlight one little wrinkle here. There's no wrinkle with the data. If you read the press release, and I've got it right up here on my terminal, Eli Lilly company announced today positive top-line results from the SURMOUNT-1, a 3-year study, 176-week treatment period. Find me somebody who stayed in the real world on this drug for 176 weeks.
Yeah.
So
we survey physicians. What do we find? 40 weeks. I'm sure it's going to go up, but that's very different setting. So how much of a real world will this actually translate into in terms of preventing diabetes? Time will tell.
So you're not saying that the study was bogus. You're saying the study was real, but in reality, people don't stay that long on the drug. Therefore, the results won't be as magical for them.
Right. In clinical trials, you get the best possible data, basically, because it's highly controlled. People are followed. You make sure that they stay on. There would probably have been people who have dropped off here. So maybe the actual average treatment period wasn't exactly 176 weeks for everybody, because people do drop off. And I'm assuming in this trial, the data they're reporting to us is what's called intent to treat, i.e. you've intended to treat that patient. Whatever happens to them, you still count them, even if they've fallen off the drug. Nevertheless, we need to see the detail. But in a trial setting, things always look better than in real world. So here we have to remember average stay time, according to our surveys that Mike Shaw, my colleague, runs every 6 months, it's about 40 weeks, similar to what we get for Wegovy. And even the press release, they say as soon as they came off, weight went back up and the risk started going up again of developing diabetes. Oh. So this is not something that you've cleaned it all up. I can stop now at 176 and I'm done. It's the same story over again.
Right, exactly. So, I mean, I look at the stock for Eli Lilly, Sam. I see it's up 64% year to date, all-time high. How much of this stock performance is these GLPs?
Oh gosh, if you look at the chart and look at the flow of information and news and the upgrades, etc., that are coming to every quarterly result, etc., to sales, I would say a meaningful chunk of this. I can't quantify it exactly because this is a company that's got other stuff going on, Alzheimer's disease, oncology, skin diseases, etc. So this is not a one-trick pony. but a large amount of this story. And you can tell by when somebody reports a positive result in a competitor setting, these stocks sell off 4 or 5%, right? If you remember the days with Roche, only 3 or 4 weeks ago, I think, right?
Yep.
So, and let's not forget, in a few weeks' time, we have the European Association for the Study of Diabetes. Roche's data is coming out. Somebody's going to be up 3 or 4% that day, and somebody's going to be down 3 or 4%. Who it is, we'll see what the data says.
So the point that you made, that if people come off it and they gain the weight back, so in that sense it's not like everlastingly magical. Will there be iterations though where that won't be the case?
There's 2 ways of dealing with this. So you go on the drug, you come off the drug, you go back on the drug, you come off the drug, and you just do your cycling. Every few, after you've got to a point where you think, I don't know why people come off the drug necessarily on an average. Is it side effect tends to get a lot better over time. And maybe it's cost. Maybe it's because they're fed up taking an injection every week. So if you put all those things together, as they get cheaper and injections become once a month maybe, or they become oral for the maintenance phase of the dose, and that oral doesn't make you feel ill every time you take it in terms of gastrointestinal, maybe that's the future. Maybe there are other modalities. Amylin is one that Novo Nordisk and Zealand Pharma are developing as a target. That seems to have less side effect issues. Maybe you can maintain your weight loss by those drugs which don't have the same side effect issue. So that has to be the way that you see it, but nobody ever complies with a drug forever.
Right. When do the pharmaceutical companies, Sam, have a timetable for when they will have a pill format as opposed to an injection?
Yeah, so they're all trying to develop them. There are a couple of companies, Roche and AstraZeneca, which have got what we would call traditional, potentially small molecules that comes in a pill. So it's not the same biologic that you're currently seeing. The folks who are developing these same GLP-1, GIPs, etc., are also trying to formulate them so that they can be taken orally. The trick there is, if it starts releasing in the stomach, you need to take them on an empty stomach so that you get absorption. If you take them on a full stomach, then you have a problem. So that becomes a bit of a headache for somebody who gets up in the morning, decides to eat or not eat, and then they also get side effects. So I would say 3 or 4 years. There is already a diabetes version, Rybelsus, on the market as an oral. But let's say 3 or 4 years.
What about heart disease? Does it actually cure heart, or reduce death, I should say, and heart disease? Do we know yet?
Yeah, we know that already. We do that. We know that already from the cardiovascular outcomes trials, the CVOTs that they've done. At least for Novo, I'd be very shocked if Lilly doesn't get the same result.
So for those on YouTube, there is literally no one.
I saw 2 people.
2 people in Sam's
by.
floor.
Guys, it's 3:30 here. It's tea time. We're in England.
It's tea time.
They're all up there having their tea.
I'm on TV at 3:30 in the afternoon, man. Paul's on the beach at that. Yeah, you're on the beach at that point. Okay, so hold up.
Exactly.
There you go.
All right. Hey, Sam.
If I turn my camera that way, you'll see a lot more people.
Okay. We got like 30 seconds left here. What's the exciting thing that you and your team are working on in terms of, what some of these treatments are out there that people need to be paying attention to?
Yeah, in general, you mean, or
Yep.
obesity, diabetes? General. Okay, so we've got three conferences coming up that we're all excited by. As I said, the European Diabetes Conference. So there, Roche will get the data, and we'll get some cuts of other data. That will be an interesting one to look out for. ESMO, European Oncology Conference, new data coming out, some press releases today for potentially surprising data. And then the World Lung Conference, where we have some new modalities being presented. All of them will have something funky going on. And for the cancer ones, we have a webinar coming up, hopefully for our clients.
Very good. Sam Fazeli, thank you so much, as always, Director of Research for Global Industries. I'm not sure what that means. He should just be head of European research when I was part of this thing, but they've changed it all up here. Most importantly, he's one of the top pharmaceutical and biotech analysts in the city of London, and we got him at Bloomberg Intelligence.
And Bordeaux, France.
And Bordeaux, France,
Yeah,
exactly. I mean, again, I'm waiting for the invite for us to go out over there and
I got a picture.
sample some wine. You got pictures?
I got a picture from Friday. But,
Okay.
it's an old pic, but still, it was something.
Yeah, he's got like a horse farm there or something. I don't know.
Whatever. Sam's just really cool, okay?
Yes.
And we just totally love him.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's go to Tesla. The stock's pretty much unchanged today. It's down about 10% year to date. It's flat over the trailing 12 months. Looks like the EU is looking to slap some tariffs on some of these Tesla vehicles that are made in China. Is this a big deal? The market doesn't seem to think so. The stock's not doing a whole lot here. Craig Trudell joins us, Global Autos Editor for Bloomberg News, joining us from London via Zoom. Craig, what's the latest coming out of the EU here as it relates to Tesla?
Yeah, this is a case of Tesla having a bit of a special situation where other manufacturers are subject to tariffs on the basis and in part of whether or not they cooperated with the EU's investigation of just how much they were subsidized by the Chinese government. And what the EU did here was they sampled a few companies and sort of took a specific look at a few manufacturers and made decisions based on what they found and on whether or not those companies complied with those investigations. And some separate rates were going to be applied to companies that were not sampled. What Tesla did was go to Brussels and say, look, we don't think that we were subsidized as much as some of the other guys, so subject us to a lower duty rate. And that's what happened here. So they're subject to a 9% tariff. BYD, on the other hand, an additional 17%. All of these rates are on top of the existing 10% that cars coming in from China face when they are shipped into the EU. And so I guess if I'm an investor, I sort of knew that this was coming, had a sense that Tesla, there was a potential for a slightly more lenient treatment. But in the end, am I happy about Model 3s being subject to 19% duties, coming in from Shanghai? Probably not.
Does this mean that Elon Musk will want to manufacture more Teslas in Germany then, or is he just going to cut bait?
I think it's a really interesting question. I mean, the Model Y is far and away, the model for Tesla globally, and I think increasingly so. Even as the company has, given a little bit of a facelift to the Model 3, the Y is really, the volume play for them, and they make those in Germany. It wouldn't be a cinch to add Model 3 to the plant in Germany, but does it make a lot more sense to build that vehicle there as opposed to shipping it in from China? It may be in their best interest to do so. The 19% duty is substantial enough to where it certainly has to make the math much more interesting in terms of whether or not they decide to pull that trigger.
So from the EU's perspective here, is this a Tesla issue or is this just a China issue? Because I know they've got tariffs on other Chinese manufacturers as well.
Yeah, I think the reason that Tesla is sort of being led with today and how this is getting covered is Tesla was sort of separate from everybody else, looking to be assessed on its own. Whereas all the other manufacturers, the duty rates were known. Tesla was still a little bit of a mystery. So this is, sort of one more sort of checked box in terms of, what the particulars are going to be for these duties that go into effect later this year. And I think this is very sort of par for the course for anything that gets decided by the European Commission. It gets decided over and over and over again, and so this is very much a broader China story and not Tesla specific.
Do Tesla EVs that are manufactured in China even make it into the EU and to that point into the US or no?
Yeah, all the Model 3s that are sold in Europe are coming from Shanghai at the moment, and so whether or not the company maybe perhaps they would potentially look at exporting from the U.S. I don't think we have a good enough sense of, the particulars of their cost base to really sort of, be able to say what makes the most sense for them, sort of immediately as a result of this change in tariffs that will go into place. But it has been interesting that we have seen the company, even before these tariffs actually take effect, bump up their prices in Europe a little bit. And you've maybe seen that result in some challenges for them sales-wise, where they've not had a very good start to the year, and that's even carried into the second half, where the initial sales results that we've seen for Tesla have not been particularly good. I think the fact that they've not been able to continue to bring prices down and have sort of been unsure whether or not all of the Model 3s that they're shipping into the EU from China
right.
may be subject to these tariffs. It has been absolutely a headwind for them.
All right, Craig, thanks so much for joining us. Really appreciate it. Craig Trudell, a Global Autos Editor for Bloomberg News, joining us from London, the Q headquarters there in London.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in New York City. You can also check us out on YouTube as well. So back to the markets. Yeah, I appreciate nothing's really happening in the broader equity market. You are seeing a little bit of buying coming into the bond market, particularly in the front end. We all look towards Jackson Hole. I'm really into the revision of the labor data that we're going to get tomorrow. Is the Fed going to be particularly behind the curve? But we wanted to get a professional to weigh in on all of this. And Dryden Pence is Chief Investment Officer at Pence Wealth Management, and he joins us now in the studio. Dryden, what do you think? What do you think we're going to learn this week?
I think we're going to learn this week that the much predicted September rate cut is on the table.
Okay.
That labor data is probably going to be revised a little bit. I think people forgot that a lot of the labor data was affected by weather. And so you had people that were temporary or layoffs or things like that. So you get these anomalies that are, when we've all witnessed weather here lately in New York City. Yep. So those things have caused it to change a little bit. I think we'll find September's on the table. I think that we'll find that the economy is still robust and not as, while it's slowing, it's not slowing to the level that others are talking about. So I think we're going to find a benign move to a quarter cut in September, and then we're data dependent to see what happens in December.
We're just finishing up, I guess, this week, kind of earnings here. We've got some retailers coming in, as well as NVIDIA coming up to kind of put a punctuation mark on it next week. What did you make of the earnings season we just had?
I think it's been a robust earnings season. The point of the matter is you had this growth scare that freaked everybody out a couple of weeks ago. But the point of the matter is that we're seeing the broadening out of earnings. The earnings situation is that earnings recessions, rolling recessions turn into rolling recoveries. And so you're seeing the earnings of the rest of the 493 of the S&P 500 begin to move forward and come out. You're seeing about a 7-8% to 13% earnings growth there. And that bodes well for the whole broader part of the market. So we're moving from Magnificent Seven, where NVIDIA accounts for all the earnings growth, to the rest of the market moving forward. So that does one of two things. It either puts a floor under it by making it stronger and stable, or it moves the market forward as we go through the rest of the year.
But only for those that actually had that earnings growth. So where did you see it? For example, like Bank of America said all their clients bought everything last week except for energy and industrials. Like, where do you see that growth? Where do you not?
Well, I think that the issue is I began to see, as we look at this later part of the cycle, we're going to see industrials begin to do better, and we think we're going to see industrials and small caps, and you're beginning to see pieces of that. Most companies are beating their earnings growth estimates as that's all come out. We're almost all the way through earnings season, but I think as you get into late third quarter and fourth quarters, we're moving through this, and you're going to see companies begin to publish and begin to show even better earnings going forward. So it's the broadening out of the S&P 500 and also small caps and industrials. We think that are going to continue to see a regular cadence of improvement.
One of the companies on your list was actually in the news this week. AMD is a company that's on your list. They made an acquisition of ZT Systems, which is a technology company based in the bustling technology hub of Secaucus, New Jersey, I know. What's your AMD call?
We've liked AMD for a very long time, and we've owned it from when it was in some of our portfolios since it was a small cap and just out there. Now it's all the way it's moved up tremendously. So we've liked it for a very long time. We like AMD here too in terms of what they're doing with their company. They're sort of the number 2 in a lot of spaces, not only the advanced stuff but just kind of the everyday chips. We've always said buy chips on dips. And so we think that with AI, with everything going on, this acquisition is AMD kind of getting really serious about going after NVIDIA. And so I like companies that are number 2 and hungry.
Mm-hmm. Okay, so it's like an AMD, not NVIDIA story for you.
Right, exactly.
Gotcha. You also like Chipotle.
I do.
Like
and
do you like it without the CEO, Brian Niccol?
Well, the point that makes a big difference, and Starbucks needed to make a change. There's probably a good move there. But when you think about the consumer, consumers are what we call have now become more conscious. At one point coming out of the pandemic, it was going to buy anything at any price because everybody had all this liquidity. Now we're seeing that the consumer is being pickier. They want value. This is why if you contrast Chipotle and McDonald's, I mean, fast food is supposed to be fast and cheap, and when it becomes neither, right, then people move away from it. And you saw that with McDonald's. With Chipotle, people are seeing value in what they're spending. So you're continuing to see, okay, it's worth the extra money for what I'm getting, and I'm paying for that. And so that becomes a more stable move. So we think that the whole story here is about a conscious consumer. They're still spending money. More people are making more money than ever before, and they're spending it, but they're being more discerning about it, and they're being a little pickier.
What do you think about the consumer here? Does that? A lot of folks are saying there's really at least 2 consumers out there. The ones that own risk assets, whether stocks, bonds, real estate, they're doing fine, and maybe even more fine if the interest rates come down. And then there's everybody else who really feels the brunt of inflation in their pocketbook. Does that impact kind of the stocks you look at?
It does. I mean, we really do focus on, we look for big knowable themes driving consumer activity. We look for choke points or companies that really, have a kind of either monopolistic power or they're very key into that consumer behavior. So what we're seeing this trend of consumers being pickier. You have people at the lower end of the economic spectrum are certainly becoming stretched. Inflation is changing their behavior a little bit, but it's very interesting. Inflation expectations have come down now. Mm-hmm. People are beginning to make some changes in that, and you did see some real wage growth. So I think the big thing that the agenda, and whether it's politicians or anybody else, it takes a little time for these things to work their way through the economy. And I think that we're seeing some stabilization of it. And consumer confidence is probably beginning to get a little bit better, not a little bit worse. Mm-hmm. So I think this is an adjustment period that we're moving from a torrid pace of economic growth to a sustainable one.
Right, like just slowing, not slumping, basically. But, back to Chipotle for a second. So this is what I've heard from Paul. You said 3 tacos?
Okay. Dave got called out on social media for skimping on some of the ingredients. Mm-hmm. So they went overboard and now overstuff your orders to the point now that I only get 2 tacos instead of 3.
So how is that good for Chipotle? Because it's good for Paul.
Yes, good for Paul.
But is it good for them? Their top line doesn't grow as much, and they have to put out more in the food.
I think they have done this is where Chipotle has a competitive advantage in that they really do pay attention to their consumers and their customers. And they've really focused throughout their entire history as how do I put these families, these people that are coming into these stores, these people that they have a reliable product at a reasonable price. And that consumers see value. And if they see value, they show up. And I think that's a competitive advantage that Chipotle has maybe against some of its competitors. And that's what you're seeing, right?
Yep.
They listen, they react,
yep.
They really react, and everybody feels it. So that's a good consumer products company, and we like those.
Yep, it's good stuff. All right, Dryden, thank you so much for joining us. Dryden Pence, Chief Investment Officer, Pence Wealth Management, based in Newport Beach, California. We've covered that territory before. I'm not buying the whole PIMCO thing out there.
It's pretty out there, isn't it?
It is beautiful. Yeah, it's phenomenal.
That's something. Yeah. As long as it lasts, right?
Yeah.
Mudslides,
falling
fires,
into the ocean.
Falling things.
It's nice. I mean, someone's got to live there. I'm glad I do.
Exactly.
All right, well, coming up, I'm going to talk to Paul about what he can expect at his next luxury hotel trip.
Nice.
Uh-huh.
Okay.
Bunk beds.
Oh, no,
yeah.
thank you.
Yeah, he's going to be into it.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We cover all the top news in business, economic, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. For now, though, we're going to go to Miami, Florida, because, why not? We're going to speak to Henri Pierre-Jacques. He's co-founder and managing partner at Harlem Capital Partners. He joins us from Miami, Florida. Now, Harlem Capital Partners was founded back in 2015. It's a venture capital firm based in New York, and it prefers to make investments in things like AI, consumer technology, e-commerce, enterprise, human resource technology, all the stuff that we talk about every single day. Henri Pierre, walk me through kind of how you guys think of the AI landscape right now, the good investments and the risky investments.
Yeah, obviously there's a lot of hype around AI. I think the way that we think about it generally is we want to invest in AI companies that don't touch anything close to the large incumbents, such as Apple, Microsoft, ChatGPT. And so we're really focused on vertical AI applications. And so some of our investments have been in super niche fields like accounting, AI services, insurance broker AI services. And so we're really trying to not touch the consumer AI marketplace. So we think distribution largely will win there for the large players.
So, Henri, we're such in the early innings of AI. A lot of people don't even know what it is, can't really articulate what it is, how it's used, what the applications
is that
are.
You, Paul?
Yeah, I'm thinking me. I'm speaking my own book here. How are you guys approaching AI right here? Because it feels to me like AI today is what we were calling big data 5 years ago. And 10 years ago, we were just calling tech. So I'm not sure what it is. How are you guys approaching it from an investment perspective?
Yeah, ultimately AI has been around for a decade plus. I think what this wave has seen is generative AI, which is more of the image and tool and video creation. And people are kind of bucketing that for all of AI. Largely for a lot of the companies we invest in, they're really just enterprise software companies that are using AI in the background. Ultimately, right now there are more CFOs and CTOs who are getting AI budget spends. And so if the company says AI, then their company will allow them to spend more. But at the end of the day, in the next 3 to 5 years, the customer only cares about how you're solving their problem, right? We've gone through the similar way for Web3 and blockchain. If you're solving my problem on Web2 versus blockchain versus AI, ultimately, I don't really care, right? But there are these cycles where you'll see spend get budgeted, and that's why you're seeing a big pullback for a lot of the SaaS public companies, because the software spend's getting drive to the AI spend. But in 3 to 5 years, maybe even shorter, that word won't be where spend is going. It's ultimately, are you solving the problem that the customer has? And so we're less focused on the technology and more about what problem are you solving. If you're using AI versus software, doesn't really matter in the day, but you will get these short-term cycles where people will have spend for certain, technologies because it's hot in the market.
Can you give me some examples of some of your recent investments in AI, like the companies and sort of why them? But dumb it down for me, for sure.
Yeah, so one that I did, it's called Test Party. So basically what they do is they help websites be ADA compliant. And so a lot of people are either deaf or blind or have blurry vision. And there's actually federal laws that require companies to have websites that are accessible to them, right? And traditionally speaking, people are going through this, either you're paying somebody in India or it's very manual, right? And now we can use AI to actually go through and scrub these sites and tell you, hey, these parts of your sites are broken. Here's the code that can do to fix it. And so you're ADA compliant, and billions of dollars a year, you'll see lawsuits where people are getting sued because their websites aren't compliant. And so this is a tool. This has been these companies have been around, but they largely were consulting services before. But now it's, instead of having to pay people to do this, you can actually use technology to help, particularly e-commerce websites, be more accessible to people who maybe not have perfect vision or perfect hearing.
Henri, what's a typical deal size? Or I guess what's a typical investment look like for you guys? Maybe in terms of size. How early do you guys like to get into these companies? What's something in your sweet spot?
We're super early. So our bread and butter is kind of pre-seed, seed. So I would say typically these companies are between 0 and $1 million of revenue. Our sweet spot check is a $1.5 to $3 million check, usually for 10 to 15% ownership. So we're really early. I would say half our companies were pre-revenue, half our companies were post-revenue. But ultimately, the stage that we're at, we're backing the founders. But like sometimes there are businesses and customers, but sometimes there's no product or no customers yet, and we're really just making a bet on the founder to kind of, go and tackle their vision.
Oh my God, that gives me so much anxiety just hearing about that.
Well, what's a success ratio?
My wife says the same.
For someone like you at Harlem Capital Partners, what's a typical success ratio? Like you've started this in 2015, we're 9-10 years into it. So how's that run for you guys?
Yeah, I mean, so for context, we started as an angel syndicate. So for 3 to 4 years, we were investing our own money into companies. And then we actually raised a fund for Harlem Capital 5 years ago. So we're on our second fund now. So we're really like 5 years into the journey of like having institutional capital. Typical, like I can give you like we're early in the cycle, but we have kind of like a 40% Series A conversion. I would say that's like really the target for a seed stage fund is how many of your companies get to the Series A. Because from there, you typically see a 60% conversion to the Series B, Series C, et cetera, and beyond. So that's like the near-term measurement that we're focused on. But like long-term, yeah, it's really hard. Obviously, early-stage venture, 3% of startups become unicorns, and it's a law of outliers, right? And so typically, if you invest in 30 companies, 1 to 2 companies will drive your returns, wow. And like that's ultimately what you're fighting for. And the other 28 will be, call it 0 to 5X's, but the one winner is the one that kind of drives your returns. So
That's
it's
pretty
not
amazing.
it's stressful.
Yeah, I mean,
that
hey,
is not
more
my risk
power
profile.
to you. No, this is definitely not my risk profile. I need a steady job. I need the whole thing. Before I let you go, we have like a minute left here. Talk about some recent investments in, say, vertical software.
Yeah, so I have a company called Finteri. So it's a reconciliation platform for insurance brokers. So oftentimes insurance companies are kind of outsourcing who they're using for the sales process. You have like 10 different brokers. They're getting paid differently, different timetables. And so now you can use AI to actually it's vertical software, but you can use vertical software or AI to help those companies actually manage the process of paying all those brokers. Traditionally speaking, those have been done in Excel files, Word documents. And so we invest in this company pre-revenue. They've grown 10X in the last 9 months. They're growing really quickly. And so what we're seeing for vertical software is a lot of these companies are looking for very specific problems because everybody has been buying software for the past 10 to 12 years. So like nobody really no longer needs this broad solution because Microsoft or Salesforce or whoever is kind of solving that. But if you have a very specific problem, I'm willing to pay for the software. But people aren't generally buying horizontal software anymore because that's kind of been done. There's already a lot of incumbents who are solving massive problems versus like this very specific problem that a company has.
Hey, Henri, this has been a real pleasure. I definitely want to hear more about how all of this continues to unfold for you. Henri Pierre-Jacques, co-founder and managing partner at Harlem Capital Partners, joining us from Miami, Florida.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We are live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast, and that's where you can find us. Talk about some volatility. 2 weeks ago, Monday, we had a VIX that surged above 60. I think I got about 65 intraday. The VIX right now for Tom Keene is at 15.4. What a move there. What's a money manager, what's an investor to do with that kind of volatility? Katerina Simonetti, she joins us. She's a senior vice president, private wealth advisor for Morgan Stanley Private Wealth Management. So Katerina, talk to us. What kind of conversations have you had with your clients over the last couple of weeks as they, dealt with that volatility from a couple of weeks ago to, boy, we're right back where we started, it seems like.
Paul and Alix, thank you for having me on. You are 100% right. This definitely is not a lazy summer. Investors are concerned. The questions that we get range from how sustainable is this rally or how long the market decline is going to last, because we see these fluctuations that are making investors very nervous. And one thing we know for sure is this volatility is here to stay. If we look back historically at these stretches, leading to presidential elections, they usually are known for this heightened volatility. And what we tell our clients is really to expect it, to be prepared for it, to take advantage of the dips in the market when it makes sense, to rebalance portfolio, to stay on the quality side, and definitely avoid making any type of portfolio changes based on what they think the outcome of the election might be, because, as we all know, there might be surprises, so we have the roadmap for either outcome, but we are going to start implementing it after we have clarity on the outcome.
Where would you buy market on dips right now, and where would you be selling any rip?
Alix, what we see right now is disproportionate overexposure to technology in many portfolios. And we love technology. It is definitely here to stay, but this is where, sometimes it's skewed and off balance. And what we recommend to do is go back and rebalance and buy on dips into the sectors like financials, industrials, consumer staples, healthcare, energy, and just to make sure that we have this strategically positioned portfolio, especially if we add the stocks or emphasize the stocks that pay dividends. Now, in addition to growth, we also have that income component that is going to help investors get through this turbulent, highly volatile time.
How about in the bond market, Katerina? How are you telling your clients to be positioned here? Should they just go take a 2-year treasury and get 4%, or maybe take some credit risk?
Well, Paul, this is where we have to make some tough decisions. We know that the interest rate cuts on the horizon, and whether we are going to get a 1/4 point cut or a 1/2 point cut, we know the rates are coming down, and towards the end of the year, they're going to get most likely lower than where they are today. So investors have a choice. They still have picks of the higher rates. When you look back, at last 20, 25 years. I became financial advisor in 99, and this is the first time in my entire career I'm seeing rates at these levels. So take your pick. There are opportunities in high yield. There are opportunities in high quality investment grade corporates. There are still, some buys that we can find in municipals. We don't recommend going out on the far side of the yield curve. We are, really trying to stay moderate in the middle, but we don't want to go too short either, because we're going to run out of rates and then, most likely default into much lower yields.
But in the corporate credit market, I was reading an article today that talked about how there is so much demand for precisely the scenario that you laid out, that you have to just go down the credit quality to get yields even at 5%. So that kind of upside that you're used to getting from the corporate bond market really isn't there. So how much risk do you want to be taking on right now?
Well, Alix, there are two sides to look at it. You might need to take on a little bit more risk, but still stay in the investment grade. The other side of it is to look at paying somewhat higher premium. And we're not talking, like 10 years ago when we're paying 10% over par. Yes, prices of bonds have moved, but there are still some buying opportunities. And there's still dips, just like in the equity markets. If somebody is looking into building their fixed income portfolio, there has to be diversification, exposure to various asset classes, like high yield, investment grade, municipal, preferreds, and just putting together this well-balanced portfolio and buying it gradually and strategically. But I probably would not wait too long, because once the rates are going to start coming down, that move to higher prices and lower quality is going to continue.
Katerina, how do you position alternative investments for your clients? I'm always surprised that retail investors have an appetite for alternative investments, whether it's hedge funds or private equity or private debt. How do you guys position that?
Well, alternative investments definitely give us an opportunity to access parts of the market that we otherwise cannot. And by doing that, we give ourselves, the access to potentially higher returns, but also alternatives can be used as very effective hedge against the market risk, where we're looking to attain the market-like returns with lower than the market risk. The trade-off here, of course, the lack of liquidity, and not all of them are created equal. Some alternatives they're a little bit more liquid. Private equity investments, for example, are not. So that's the trade-off for investors when they're making a decision to go into this alternative space. We absolutely see opportunities, distressed credit, real estate. There are some, pockets of the market that can be accessed there, but lack of liquidity is something that is a very big consideration for a lot of investors.
Oh, yeah. Just check out the last couple weeks. What about small caps? Can you give me the spiel on small caps? It feels like these guys are definitely hitting a binary world. Like you either love them or you hate them.
Well, absolutely. And Alix, not that the history always repeats itself, but when we look back at the past cycles, once the rates are starting to come down, usually we first see the uptick in large caps, but then it's followed by the upticks in small caps. And broader on the economic level, we have the higher interest rate environment, which is affecting consumer confidence. And also it is affecting profitability of the companies. And, on one side, we're happy that inflation is coming down. On the other side, this is where, the profit margins are being squeezed as well, more so for the small caps than for the large caps. But at the same time, it might be a delayed reaction, but we absolutely are positioning small caps in the portfolio. The returns that we have seen recently are somewhat of a surprise because for us is more of a long play. We're looking at the longer time horizon for that position.
Hey, Katerina, we're just finishing up on earnings seasons. What's been your takeaway for earnings so far?
Well, Paul, we've seen, pretty good earnings so far, in the year, which was almost a pleasant surprise. They were better than expected. Our outlook for the remainder of the year is not quite as optimistic as we see earnings being affected by consumer confidence, by higher rate, by lack of liquidity, and also by just general economic slowdown. And our base scenario is still that soft landing scenario that is going to affect some parts of the market and some parts of the economy. But we see the earnings being not quite as good as we saw earlier in the year. And the most important piece of data for us are these forward-looking estimates as companies are posting their earnings, for us to really see how well they're positioned in the market. And that's why in this particular time, we favor individual stock investing versus index investing, where we can specifically focus on valuations, on market positioning, and on the forward-looking outlook in earnings.
Before we let you go, Jackson Hole, what are you looking for?
Oh, who knows?
Who knows? No, that's a great answer.
It is really just so difficult to pinpoint and exactly exact data that should come out of it for us to to build the roadmap. But we're looking for just a little bit of positivity to give investors some good news during this time of market volatility prior to the election.
Right, so like slowing economy, but not like a slump economy, like that kind of idea.
That's exactly right. Anything that leads us to soft landing, is good enough for us.
All right. Well, appreciate it. Thank you so much, Katerina Simonetti, joining us, Senior Vice President, Private Wealth Advisor of Morgan Stanley Private Wealth Management. I feel like the Jackson Hole conversation would have been really different like 3 weeks ago, like if it was right after that jobs number. And yep. I wonder if Powell winds up changing or talk about the market reaction in relation to jobs. Like, right. I wonder how he talks about that if he does.
Because again, 2 weeks ago Monday, there was, particularly in the morning session, a real sense of panic.
Exactly.
Panic in the marketplace. We stabilized kind of midday, kind of rallied a little bit towards the end of that day, and then ever since then, they're kind of moving up and to the right.
So. You forgot that Friday because you were on the beach, but yeah.
Yes.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.